Hello everyone, I'm your host Trisha and welcome back to our weekly tanker market podcast. In this episode, we discuss the latest trends and insights in the tanker market for week 48. And with me today is Sandesh, our expert on crude, CPP and LPG markets. Hello Sandesh, it's great to have you here.
Hi Trisha, pleasure to be here. We have got an exciting mix of updates to cover today. So let's get started.
Right, so let's have a look at the crude market. Last week gave us plenty to talk about. And it's not every winter that we see these kind of movements, especially in the VLCC market. So what's your take on what's happened over there?
Well, Trisha, the VLCC market had a rough week, no doubt about it. We started with the stable but sluggish sentiment, and then things took a bearish turn as the week went on. The main issue was low cargo demand, particularly out of Middle East. And at the same time, we have an oversupply of tonnage. XMEG, that is Middle East Gulf segment, it started with the sluggish sentiment due to weak loading demand. But as the week progressed, the market turned increasingly bearish. And with that, rates declining to unusually low levels for the winter season. This was mostly due to an oversupply of ships and reduced Chinese demand, that mainly driven by lower refinery intake following cuts to export tax rebates. Now that's about Middle East Gulf market. Let's talk about West African market. In West Africa, sentiments weakened early in the week as ship owners accepted lower rates to secure cargoes. We witnessed a midweek uptick and it was fueled by momentum from the Suezmax segment and not the VLCC segment. And this momentum from the Suezmax segment, it was short-lived as vessel ballasting from the MEG increased ships availability and pressurized rates once again. Now, meanwhile, in the Americas, that is ex-US Gulf market, bearish conditions persist, with the rates remaining stable or softening slightly. And it was due to low activity and heightened competition amongst owners. Talking about the Latin American markets, the Brazil-China route also weakened, and the US Thanksgiving holiday further dampened the already quieter market. Across all regions, we have witnessed a weak demand and oversupply of underscored tonnage that struggles for the VLCC segment.
And wasn't this downtown especially unusual for the winter season? Like normally we'd expect strong activity, right?
Exactly. Winter usually brings higher demand, but this time China's reduced export tax rebates on the refined products have really cut into refinery demand for crude. As a result, we are seeing a fewer VLCCs heading to China, which is a key route. And Tisha, on top of that, TD2 and TD3C, those are the benchmark VLCC routes, the rates fell over 15% week on week basis. And that's definitely not what owners want to see.
So, do you think the market could bounce back anytime soon?
In my opinion, not in the immediate future. But I will say that there is still hope that the second half December cargoes might bring some activity. But a big rebound feels unlikely unless there is a strong shift in the fundamentals.
Yeah, that makes sense. Now, let's shift gears to the Suezmax market. So, it seemed like last week had a bit more action over there. So, what stood out to you the most?
Well, the Suezmax market had quite an interesting week across regions. For example, ex-Middle East Gulf, things started off steady, even though market was quiet. Early on, there weren't many ships available for December loading. So owners had a chance to push for higher rates. But as the week progressed, we have witnessed more vessels came into play and that momentum fizzled out. And on top of that, Trisha, there wasn't much fresh cargo, so rates stayed under pressure.
So, how did things look in the West Africa region?
Well, West Africa was a different story. The week began with some optimism, but rates were holding steady and there was a bit of bullish vibe because there wasn't too many ships available. But then as week progressed, the demand softened and more ballasters showed up, and it increases the tonnage list as well as it deepens the rates down slightly. And by the midweek, things flipped, activity spiked, and TD20, which is a benchmark route for Aframax, the rates shot up by 12.92 points. And even after that, though the market settled back to normal as activity cooled off in the later half of the week, overall TD6, that is again another benchmark, was up 9.32%, and it was at world scale 99.7 and TD20 surged 16.14% to world scale 85.94. And Indian PSUs, well, they quoted 3 cargoes last week with ex-MEG East Coast India fixture landing at around world scale 98 for Suezmax.
Okay, so it sounds like it was more of a temporary uptick than a sustained rally.
That's exactly my point. The market's finding its balance again, but with more vessel ballasting from the Middle East, charters now have more options, which could cap any further rate increases.
Got it. And what about Aframaxes? That segment seemed quieter compared to the others.
Yes, Trisha, you are right. It was a pretty subdued week for Aframaxes, especially in the Middle East and Southeast Asia. The activities was limited and tonnage oversupply continued to weigh on rates.
So, is there any signs of relief for Aframax owners?
Well, there is a cautious optimism tied to China possibly expanding import quotas towards the end of the year. Let me tell you, Trisha, if that happens, it could boost demand and stabilize the rates. But having said that, for now the market remains under pressure. The TD14 benchmark route, for instance, was down over 3% last week, and unless fresh inquiries pick up, rates might slip further.
All right, now let's have a look at the CPP segment. So, LR2 seems to have had a standout among the clean tankers. So, what's your take on this, and what do you think is driving their performance?
That's right, Trisha. LR2 had an impressive week last week, and their benchmark route TC1, that is going from Sikka to Japan, rates surging over 19% week on week, and it settles around 120 world scale points. At the same time, earnings also pushed higher. They were around 23,000 per day, and it was a strong result compared to the recent weeks. The primary driver here was a tightening position list as fewer LR2s were ballasting westward due to weak European gas oil demand. Now, talking about the east of Suez market, they benefited a lot from this shift, and it allows LR2 to hold a rare premium over LR1s. However, this premium might shrink as more LR1s return to the market in December. On the AG west of Suez route, rates were weaker and it limiting the broader rate differentials. Overall, the segment is benefiting from tight tonnage availability. But having said that, the rate momentum may be capped as fleet dynamics normalize.
That's interesting. Now, speaking of LR1s, they seem to have had a quieter week compared to the LR2s, but there were some gains. So, what's the story over there?
Well, it was indeed a more subdued week for LR1s. TC5 rates, they were edged up just below 2% week on week, and they stood at around 112 world scale points. And at the same time, earnings are also improved for them by 6%, and they were around $12,000 per day. Activity picked up towards the end of the week, particularly in the east of Suez markets, but the segment struggled with limited cargo inquiries. LR1s faced a stiff competition from LR2s on long haul routes, where the economies of scale favored the larger markets and the larger tankers. Now, talking about the Atlantic market, in the Atlantic, rates have firmed slightly to world scale 127.5 as thinning tonnage and port delays help to support the market. Looking ahead, we think that LR1s could face pressure from ample fleet supply, especially on the long haul routes like Mediterranean, Japan, though the shorter haul trades might hold steady.
Got it. And for MRs, I noticed mixed signals like soft fundamentals, but still some gains in the earnings. What's happening in that segment?
Well, let's talk about MR. MRs had a mixed week last week. On the Sikka Japan TC12 route, rates dipped slightly by 0.1%, but the earnings rose 4.4% to $7,688 per day. The real highlight was, Trisha, that TC17, where the strong short haul distillate demand and tightening vessel availability in the East Africa pushed rates up by nearly 6% to world scale 180. Now, Pacific markets, however, lagged due to weak cargo availability in the North Asia, with earnings averaging around $17,500 per day. On a broader scale, we are seeing tonnage list tighten east of Suez, and that could support spot rates in the near term. However, all eyes should be on refineries because refinery economics and regional crack spreads are shaping the demand. The gasoline margins in Singapore are up, but in Europe and USDC cracks have softened, and it creates a mixed outlook for global flows.
That is definitely fascinating how these segments are evolving. So now let's move ahead to the LPG segment. And it seems like the east of Suez market has been pretty quiet this week, with only a couple of deals and steady rates. So can you walk us through what's happening in this region, especially with December fixtures coming into play?
Well, exactly, Trisha. The east of Suez market has had a slow week with limited activity. Now, the freight rates for the Ras Tanura Chiba, which is again a benchmark route, they have remained steady around $50 per metric ton mark. And activity from India has been on the quieter side as well. With just one cargo for late December lake and floated in the market, but it still remains unfixed. With the position list looking well supplied and December fixture count approaching historical averages, there isn't much reason to expect any major improvements in sentiments in the AG market for the short term. Now, having said that, it feels like we are heading into the month with steady, if not sluggish conditions.
Well, now that sounds like a quieter period for the east of Suez market. So, Sandesh, what's the outlook for the west of Suez market as we transition into January?
Market has also been fairly quiet, specifically for the propane and butane shipments. There were only a handful of fixtures for the end December laycans, and the rates have remained stable. They reach around $105 per metric ton for the benchmark Houston Chiba route via Panama. Now it looks like December fixing is mostly wrapped up, and now the market is turning its focus to January. The early 2025 position list seems well supplied with several relays for the early month bookings, which could put some pressure on the market. And given this, we may see sentiment soften during the first 10 days of January, with a potential dip in rates as the market moves into the new year. Having said that, that's it from my side for the LPG market. Thank you, Trisha.
Well, it definitely sounds like a quieter than usual period as we head towards the end of December. Anyway, thank you so much, Sandesh, for your valuable insights. And to all our listeners, thank you for tuning in to this week's episode of the Weekly Tanker Market Podcast. And do not forget to share, subscribe, and follow us on social media for the latest updates. Until next time, navigate safely and stay informed.